Howdy, Jake here. Today we're looking at Brunswick Corporation in the leisure products industry. 5.2 billion market cap on 7 billion enterprise value. They design, manufacture, and market recreation products in the United States, Europe, the Asia Pacific, Canada, and internationally. Founded in 1845. They've been around for quite some time here, and they are still producing increases in revenue, which is great for them. We'll see where that is coming from, whether that's organic or inorganic, but pretty impressive growth, likely mid-single digit compound annual growth rate over the last 10 years, with gross margin very consistent in the upper 20% range, and operating margin also fairly consistent in the low 10s, 11s, 12s range. And earnings per share, good growth there, over double. And dividend increased quite heavily as well. Return on invested capital, pretty solid, low double digits. Okay, everything I'm seeing so far looks pretty good, except maybe this debt. So let's look at how much it is in relation to free cash flow. 468 million cash on hand with 455 million short-term debt. So they have enough cash to pay off that short-term debt, which is positive. But they do have $2 billion long-term debt. So let's see how much that is in relation to cash flow. $2 billion. And again, looks like there's a mistake here. I'm assuming that this other line is their capital expenditures line. So their average 5 years, maybe say $400 million. So it is about 5 years of their 5-year average free cash flow, which is definitely on the upper end of where you'd want it to be. Not immediately concerned, but it is one of those times where you need to look at, have they paid down debt historically? Not really. We have 3 of the last 4 years of heavy issuance of debt. And then when is that debt due? You're going to want to be comfortable with that if you are going to invest in this company. If all their debt's due next year or 2 years and they're not able to refinance at their current leverage ratios, then you definitely want to be a little bit concerned about that. So I think when you do your forecast, like always, you have to balance out what you want the company to do with what they've done historically. So something like this, I wouldn't necessarily say 75% of their money is going to go to share purchases, 25% to dividends, and I'm good. I'm going to have to balance out debt reduction, and so that's going to limit their ability to buy back shares, pay their dividend, make acquisitions, reinvest back in themselves, etc. So I think we're ready to start making some assumptions here. The revenue growth side, probably comfortable sticking with that mid-single digit range, maybe on the lower end. Let's do maybe 4%. And then pretty big growth from acquisitions. So I think I'm comfortable with 13p at the end of 7 years. And then let's stick 7 on the dot. Feel good about that. Share change, they're buying back shares. Let's see. So 5.2 billion would be about 52 million for 1%. Offset stock-based compensation. Let's do 2%. We're looking at about 110, 130. 130 is about maybe a third, roughly, of their free cash flow. So I'm feeling pretty comfortable about that. Their dividend is paying out 112 million. I don't want them increasing it beyond that because I do want money left over to be paying down debt. And so this is saying that they're left with almost about 40% of their free cash flow to pay down debt, maybe 40 to 50% to pay down debt, make acquisitions that make sense. But really to invest in this company, I'd want to meet our differences at both ends. So I want them to start reducing debt, have net negative numbers here, and then start realizing that you can't always just go into more debt to increase profits, to increase revenue. They're going to get to a point where you're going to have to pay it back. And for them right now, their growth isn't outsubstantiating their debt increase of the last couple of years. And so their ratios are going up. But definitely solid company. Feeling pretty fine about it. I guess I will change one thing quick. So I've started to, in more recent videos, I've started to put the terminal PE closer in relation to their enterprise value than their market cap. And again, that's just, you can put it in your, for me, it's just you can put it in your discount rate, you can put it in your terminal PE. It just gives you some extra margin of safety there. But this is basically saying at the end of 7 years, they still have a little bit of net debt there. And so it's relating the PE to that enterprise value rather than market cap. But 28% drop to get to the price we're looking for with a 15% return. I think that's reasonable, and it likely won't be too far off until we do a deeper dive here. But until then, I do hope you enjoy your time and have a great rest of your day. Thank you.